Hi, Claire. My question is actually just related to what you just said. What kind of empirical studies did you do to determine whether there was any evidence that bigger banks added value or not?
Um, we didn't do any primary research ourselves. We looked at the academic research that was done, and none of this is clear cut. And I think we did reference it in our report, probably somewhere in the deep in an appendix. But we had quite enough to do without getting into those kind of questions. So I think what we did was we tried to draw stuff together and put it in there for people to read, but we didn't make any recommendations.
It's covered in one of Andy Haldane's recent speeches.
I know.
Anybody wants to look it up.
Yeah. And Andy Haldane is one of my heroes. I think he's fantastic. He does a whole series of really interesting thought pieces on banking, and that's his most recent one.
There's another question over there.
Hi, Claire. I have to address this question to you. I'm Kavita Kumar from Lloyds Banking Group. Given that you sort of alluded to it when you said banks had high returns historically only because they took a lot of risk, and in the new regulatory environment, those returns may or may not be repeated. Looking at current market valuations, do you think that it's overdone? Because a lot of the analysts seem to quote the regulatory uncertainty as one of the big reasons why banks are undervalued right now. And do you think that that's the right balance we're achieving?
It was more about, we just can't see why a business model, why any bank thinks that it should be getting those kind of returns. Because if you've got a risky business model, you should get those kind of returns. If you've got a safer business model, you can't expect those kind of returns. So why are banks expecting to get any more than 8-9% returns, and why are they planning to and saying to shareholders they expect to get much higher returns? That has to imply that they've got a far riskier model than we think is appropriate. I mean, again, we didn't sort of say what's the right kind of level of return. It was implicit in everything we did that we were trying to de-risk, increase the cost of capital, change the way in which banks operated, and make sure that the risks were going to be reflected by. If they go bust, people would take the consequences. So I've been continuously surprised by how banks keep on saying they expect and intending to go for very high rates of return. It rather implies that they haven't got they are too highly leveraged still, and that needs to change. And I guess regulatory uncertainty is partly there because we aren't at the end of this road yet.
There's another question over there. You might. You may, if you want, ask the other panelists as well.
Hi, I'd like to ask Professor Schaefer on his view on two topics. One is, how can bank boards do the job when sometimes the CEO is the chairman in a lot of large banks? And the second topic, sorry for asking two questions, is what do you think of living wills and how realistic are they? Thank you.
Well, I think if I deal with the second one first. I think those things help. I think one of the things that we did see in the crisis was that many forms of bank debt that were supposed to be loss absorbing, in the kind of need for, you saw this in Ireland, for example. That's the one I'm thinking of. The need for urgent action in the face of a crisis means that there's just no time to intervene and force losses on subordinate debt holders before banks have to kind of close their doors almost. So I think maybe if they'd been better organized, they might have done it. But I think the kind of a lot of the hybrid instruments that that were created that were supposed to sort of be loss absorbing were not very helpful at all. And actually, there is another point here that I think is sort of central to a central problem, and that is that we're maybe not completely clear about why banks are so enthusiastic about leverage. Right? I mean, it's completely natural, but actually it's the only sector in the economy that is sort of sees leverage as somehow critical to business success. I mean, there are a number of possible reasons, but undoubtedly the tax benefit is one. I mean, that's common to everybody, but despite everything that's been said, relatively speaking, bank assets are relatively safe compared to most business assets. So they almost certainly can support a higher level of leverage than most people. But why they are so insistent that somehow the bank is better off with 3% capital if it only could sort of, get that rather than 10% capital, that's sort of just not clear at all. I'm sorry, I've got...
The CEO chairman question, I think, was the other one.
Sorry, what was the question?
CEO and chairman in a combined role?
Yeah, no, I think the more independence in boards, the better. I mean, I think the one thing they can do, right, is they can do something about culture. They can do something about making judgments about people. So the more kind of independence there you have, I think the better.
Can I comment on that? Because I'm also sit on the boards in the US where there's a very common, it is very common that chairman and chief executives are the same person. And you don't, I actually think it's really bad corporate governance because I think the chairman and chief executive dynamic is really important because it means you've got a check and a balance. You've got two people in the organisation and the chairman runs the board, and it means the chief executive has to, he is not controlling both the board and the information going to the board. There is an independent person trying to ensure that the board gets a balanced view of things, and who can also interrogate and who also can help the board decide to sack the chief executive or vice versa. I think it's a really important corporate governance, and I cannot understand why the States finds this odd. And actually, I won't join a board in the States unless they are separated.
As the token American, I would agree with that, but let's also take a look at some of the British bank failures. I mean, the chairman and chief executives have been split. So I mean, I think it is bad governance. I also think the American habit of having one executive director on the board, which is the chairman and CEO, and everybody else external is a really bad idea too. Because I think you need to empower other executive directors to sit around that table with an equal voice.
Quite agree. So everything's not funneled through the chief executive.
William Clayton-Smith with a rather parochial question about what's actually happened on UK bank boards. Before I came out today, I was actually having a look at the boards of the quoted banks, and I noticed that with the exception of Standard Chartered, which has 6 executive directors, all the others have come down to 2 executives on the board, or 2 executives and an executive chairman, which is a big change from the days when there were a number of executives sitting on boards, and to my mind doesn't comply with the corporate governance code recommendation of an appropriate balance between executive and non-executives. And it's interesting that, you know, you did say most people think about the independent directors on the board, but actually in the unitary board structure, the executives have an important and under-acknowledged role in providing the check and balance to the CEO. And I do wonder whether the panel feels this can be done as well with only a CEO and a CFO on the board as when there were more executive directors on the board.
It's something I feel very strongly about because it does mean that the power of the chief executive to decide what comes to the board is leavened because you've got other people around the room who understand the operational issues and to whom questions can be addressed. And who, I mean, it is still difficult because it is difficult for an executive who reports to the chief executive to make a statement that contradicts what the chief executive is saying. But you hate because there's enough body language, just enough stuff going on that you can get a sense that something's not quite right.
And the role of the chairman to encourage other executives to participate, not just as sidekicks of the CEO.
Yes, yes.
There's another question.
Yes, Richard Baker. Just leading on from that, I would just be interested in your commentary on, there's a lot of emphasis on what's just been discussed and the need for independence. And I just wonder, when the requirement for all directors is and the responsibility is exactly the same, actually, whether they're executive or not, why we think it is that we need these independent ones to be challenging these executive ones, when in fact the executives have the responsibility to the owners like all the others.
I mean, it's because if you, it's groupthink. If you've got just executives all with the same experience, possibly grown up with the organisation. Number one, Remco, for a start, remuneration. The executives have got very different interests, for example, than the shareholders, and there's all the agent problem. So, and if you've got good independence, they have their own reputations at stake. They want to ensure that there is good governance and that the people do treat all their stakeholders appropriately. I think it's a really good dynamic, actually, to have a combination of executives and non-executives on a board.
I would say independence can be overrated, particularly if somebody is so independent that they may not know the sector well and then may be therefore dependent upon management to explain the sector to them, in which case they're not independent. So we need to be, and this is why I think having executive directors on a board is useful because they will know where the bodies are buried in a way that a non-exec would not.
No, I think it's interesting, the Monetary Policy Committee, which has Bank of England insiders and has and has outsiders on. And there was this difficulty some years ago when the outsiders insisted that they have resources to go outside the bank to, if you like, verify, elaborate on, whichever word you want to use, on the information they were getting inside the bank. And it's interesting, Mervyn King did not agree with this, but in the end had to give in. And those outside directors, they have resources to gather information outside the bank. I wonder whether non-executives should have similar powers. I know it's a problem because if you go outside and then you come and disagree with the CEO and say, well, I've got information that is just not consistent with that, you know, that does raise problems. But I think to be an independent director, you cannot just rely on information given to you by the CEO or chairman's office. You have to inform yourself outside the business and have the resources for that. So I think that is I think that is an interesting idea, but I've talked to CEOs who hate the idea. It looks as though you're giving resources to independent directors to second guess the CEO. And I think that's very unfortunate, but it works very well on the MPC.
Yeah, maybe just following on the question that I just asked. I mean, clearly it seems that all of you, to the question, can bank boards do the job? You would all answer no. My question is, and maybe I have the implication actually beyond finance, but why do we have boards then? And should you just get rid of them?
If I may say, I think the problem is, without structural changes, boards cannot do a very effective job. I mean, there may be banks where they can, because they're simpler organizations that have a different culture. But in these complex banks, like being a director of Barclays, I think currently this is an impossible job. You can do it the best you can, and I'm sure it's a lot better than nothing. I think but can they do an effective job? Can they satisfy themselves that there's not going to be a trader who's going to make $1 billion bet tomorrow morning? The answer is, of course they can't. What about a mis-selling scandal? I think it's how to address that problem, how to get the independent directors to kind of have more confidence. And without structural changes, I think that job is just too tough.
Are they overloaded as well? Because, I mean, if I think about Barclays, for instance, they're having to change the whole culture, they're having to change the compensation. And at the same time, they're dealing with something like this week where we've seen the US energy regulator giving them a fine for something that happened between 2006 and 2008. So they're having to deal with all the legacy issues, and at the same time, they're having to you know, completely change the bank. Are there more questions? Yeah. There's one over there.
Thank you very much for an interesting discussion. We heard a lot about culture versus the objectives of different stakeholders. Do you think that in order to align these objectives better with the culture of a bank, should the bonuses be paid out in the same instruments as these stakeholders are holding? And is there such a thing as the best or a second best instrument, financial instrument, that these bonuses should be paid out in? Thank you.
That's picking up on a suggestion the Likkonen report has made to pay bonuses in bail-inable debt.
Yeah,
Yes.
I'll take a stab at that. I think that the aspiration, I think, is an interesting one, in which I'm sympathetic with. But if you think about what a CoCo, a contingent capital bond, is like, this is a bond that, first of all, ranks in the capital hierarchy higher than equity, and it pays out, even potentially in cases if dividends aren't being paid, pays out premiums, coupons that are very fat and very thick that anybody would like to have a piece of. So you could argue as to whether that is the best way to get. I think we do need to make banks think like creditors a bit more. I think we need to have shareholders thinking a bit like creditors a bit more. My response to maybe to twist that I'm not sure contingent capital is the way to do it, but if you do make bonus payments contingent or linked to things like potentially credit quality, cost of debt capital, or what have you, if you sort of have that as an underpin to a remuneration structure, I think you can potentially get the same end in terms of ensuring that you're getting to your goal of profitability within established risk parameters that isn't betting the bank literally on getting there. And I think that's a way to get that type of mentality. If it's achievable, I think that's a better way to do that than paying contingent capital, because I think it's a bit of a giveaway, frankly, as it's currently being structured.
Credit Suisse had one such thing. They've done it on their legacy assets and the legacy debt they had, and that was a huge success. But a huge success for the employees because they got a massive payout out of that.
If you could make contingent capital at not at an 8% rate, but maybe the government rate, which sort of deals with the moral hazard rate. If you could make contingent capital